मेरे बैंक में बैलेंस है, मेरे पास डेबिट कार्ड है, लेकिन मुझे लिक्विड कैश अवेलेबल नहीं हो रहा है। लाइन 2-2, 3-3 घंटे की है, फिर भी मैं लाइन में खड़ा हूं, बट द एटीएम वाज नॉट हैविंग द कैश। कुछ याद आ रहा होगा आपको। डीमोनेटाइजेशन के बाद एक ऐसा टाइम स्पेन आया कि 1 या 2 महीने तक कैश ही अवेलेबल नहीं हो रहा था। मेरा खुद का पैसा है, बट आई एम नॉट एबल टू गेट इट आउट ऑफ माई अकाउंट एंड वी वर सीरियसली फ्रस्ट्रेटेड. And that is what was the problem of supply of money. So after going through the demand for money in the earlier unit, now let's go towards the supply of money, which is the second unit of chapter number 3, Money Market, unit 2, the concept of money supply. This chapter will give an idea about how the supply is decided and how government plays an important role in making the supply as well as controlling the supply in the market. So let's start with the money supply, the main. It is the available stock of money with public. How much cash is available, which is called as disposable cash. It is the flow concept, that is, it is calculated on a specific date, say every month end, etc. It is measurable in the quantity. We can say that this much amount is or this much cash is rotated in the economy. So it is quantifiable. It is more than what public holds for their consumption. How is it possible? More than what they hold for consumption, because they are having some money blocked in bank account also or in FDs also. So it is more than the liquid cash available. It is the stock of money available with public for expenditure. It includes the stock with all the citizens plus the money with non-government banks, etc. So for the banks also, that is, the bank needs to keep some cash. It does not include the cash available with government as well as government banks. So that amount is excluded. Non-government banking institutions like NBFCs, that cash has been added. But what is the cash available with government is not added in money supply, because obviously it is not made open for general public. It can be controlled. Money with public can be controlled by government through its monetary policies. The decisions taken by the government is called as monetary policy. The source of money supply. Let's see what exactly is the source of money supply. From where this money supply comes? The decision of a central bank, and second, the response of commercial banks. Let's see how. Measurement of money supply. It's a bit difficult task. Every country uses different bases for measurement of money supply. Every country is having its own basis. From April 1977, the RBI publishes money supply on 4 bases. What are these 4 bases? In India, we are following this policy. M1. M1, that is money 1. Currency notes and coins with people, that is the liquid cash, we call it as. Demand deposits with bank like FD, recurring deposits, plus other deposits with RBI. This is called as most liquid form of cash. M2, that is M1, that is liquid cash, plus saving deposits with post offices. Nowadays, post office banks are not having that much money, but still, if any, that is added. M3 is M1 plus net time deposit with saving banks. That means the banks which are holding the saving account, that is M1 liquid cash plus net deposits. M4 is M3 plus deposits with post office saving organization. It is the least liquid asset. That means the amount is blocked now in the banking system. So M1, M2, M3 and M4. Now in this we have seen the concept demand deposit. Demand deposit means the deposits kept by general public with the banks and also interbank deposits. The amount kept by general public with the bank and amount kept by one bank with the other banks. If we eliminate the interbank deposits, then it is called as net demand deposit. So earlier it is called as gross, now it is net. Interbanking amount is not included, just general public kept investment or FDs in the bank. Other deposits with RBI, we have seen that is also added in M3. It includes demand deposit of quasi-government institutions, other financial institutions, balance of foreign banks in India and foreign governments, and accounts of international agencies like IMF. So other deposits with RBI means the amount kept by other banks, amounts kept by the foreign banks, as well as IMF also gives some funds. So whatever amount goes to all this is called as other deposits with RBI. It is also added in M4. Now measurement of money supply, new categorization. It's a latest categorization done by the RBI. NM1, that is new money 1, we can call it as. It is of course almost same with M1, but some changes are made. Currency notes and coins with people, liquid cash. Demand deposits with bank, other deposits with RBI we have just seen now. So this is the most liquid form, also called as the narrow money. NM2, that is NM1 plus short-term time deposits of residents, maturity period less than 1 year, not NRI, only residents. NM3 is NM2, that is NM1 and NM2 combined, that is NM2 plus long-term deposits of residents. Now earlier it was only short-term as we have seen, now it is long-term also, plus call or term funding from financial institutions. So if I have taken long-term borrowings from one financial institution, kept it in my bank, that is also added. Now the next concept is reserve money. So we have seen NM1, NM2 and NM3. Now next is reserve money. What is reserve money now? It includes currency in circulation, whatever currency we are actually using, plus bankers deposit with RBI in the form of, let's say, CRR, which we are going to learn in the next unit, and other deposits with RBI that we have seen, that is of foreign government, IMF, etc. So currency in circulation, bankers deposit with RBI and other deposits with RBI is called as reserve money. In short, the total money available in the hands of government. Reserve money. It is important because it determines the level of liquidity and price level in the economy. It plays an important role in liquidity, stabilization, growth and price level in the economy. It's very simple. If you are a finance minister, if you know the reserve money, that is how much is the total cash flow in our country, you can take all the steps to control and to keep the stable prices. Special categorization for RBI for liquidity. Now we are talking about liquid cash. That means the near cash or the amount available for expenditure. NM3 plus all deposits with post office banks, saving banks excluding the national savings certificate. That means now one more thing is added, that is the amount kept with post office banks. L2, that is L1 plus term deposits with the term lending institution, that is the loan giving institutions, and refinancing institutions plus term borrowing by FI, that is financial institutions, and certificate of deposits issued by financial institutions. Now this is not the real cash, these are the certificates made available to me, like I have purchased some debentures, that is also added in the form of L2. So this is something new introduced by RBI. So even though you are not having liquid cash, but you are having the certificates which can be converted into liquid cash. L3 is L2 plus public deposit in non-banking financial companies also. So this is the latest categorization made by RBI, but of course you must know all three categorizations. Now coming out of the conceptual part, pause ye thoda bore ho jata hai. Okay. So let's see how exactly money supply works and what are the determinants of money supply. It's easy to understand. First is central bank policies. What exactly central bank decides? For example, it can keep the control through the interest rates. If CRR, SLR are increased, then the amount available in the hands of banks will be very low. गवर्नमेंट ने अगर कहा कि वाटर डिपॉजिट कम्स टू यू, उसमें से आपको 30% रिजर्व्स में रखना है, ओनली 70% विल बी अवेलेबल टू बी गिवन टू पब्लिक. सो गवर्नमेंट पॉलिसीज. It is exogenous, that is external control system by central bank, or the exogenous or the internal system also. That we will see in detail, of course. Second, people. Here the demand for money and the supply depends how public think. If I think that speculative approach, that the market will go up, I need some cash to invest in share market, I will demand for more cash. So it depends on thinking of public. In practice, the supply money is net effect of both. What is net effect of both? What is demand created by general public and what is the policy decided by government, whether the cash should be supplied or not. It's a net effect of both the things. Now, there is one approach called as the money multiplier approach. It is propounded by Friedman and Schwartz in 1963. As per this approach, supply of money depends on the monetary base in the country. So supply, you cannot get the money right from air. You need some base of money available, then only you can supply. So they have strongly recommended that you should analyze the monetary supply, that is monetary base for supply in the country. So as per them, M is equal to small m multiplied by MB. M means money supply. How much money supply is possible in our country? Small m is money multiplier, that is relationship between two factors, that is money supply and monetary base, MB. So let's check it again. So M is equal to money supply, that is the money multiplier, and which is the relationship between money supply divided by monetary base. What is the base available and how much is the money supply we are going to plan. And MB is a monetary base. What is this monetary base? Of course, we are going to analyze. Monetary base, it means the total money supply in the country. How much money supply available in the country? As you know, stock is different and supply is different. Let's say in general terminology, if I have got 10,000 units in my stock, maybe I will supply 8,000 only. So monetary base is actually the stock available for supply. Monetary base. It means the total money supply in the economy. The determinants of money multiplier that we are just going through. The stock of high power money H. What determines the base, monetary base and the money multiplier? First factor which determines the base is H, the stock of high power money. It depends on the behavior of the central bank and its monetary policy. What is the policy of central government and RBI, that is central bank, towards making the money available? As I said, if it is lenient and having very low interest rates on loan, more amount is available in the hands of public. So it depends on the behavior of public and the policy of central bank and government. Second, the ratio of reserves with the bank to deposit, ER divided by D. It's a ratio of reserves to be kept by bank from the deposits while giving the loans. As we have seen, we generally call it as margin money or CRR or SLR also. For example, reserve to be kept is 10% of deposits. It means if I have got 1000 CR deposits in current year, 10%, that is 100 CR is not available for loan, 900 CR will be given. So what is the ratio of reserves to be kept to be given as loan from deposits? The ratio of reserves with banks to deposit is if CRR and SLR ratios are high, then the amount credit available reduces, as we have discussed. Thus it depends on the behavior of commercial banks also. It depends on the behavior of general public also. So the ratio of currency to deposit, that is C by D. If the public decides to hold more cash with it, then the deposits with the bank goes down and the money supply flow is affected. What is that? If my amount received in current year, net salary received by me is 10 lakh in current year, out of which I am ready to invest or keep only 10% in the bank, then that much amount is only coming in the regular flow. If 9 lakh rupees is kept in a cupboard, it will never come in a flow unless I make the expenditure in the market. So it depends on the ratio of deposits with available currency with individual also. In short, the supply of money in the market not only depends on government policy only, because it ultimately results in the reserve ratio, but also the tendency of public, how much to save and how much to invest in the or deposit into the bank. Of course, if you deposited 50% into bank and it made an expenditure of 50%, 100% cash flow is available in the market by either of the ways. But if you keep it in liquid cash, it will not be available in the market. If the interest rate on deposit is good, the public prefer to keep deposits and cash flow in the market obviously increases. If I am getting a good return, I will invest it into the bank. That money will be given as loan to the industry by the bank. So more amount is available. So that was a tendency of general public which affects the supply in the market. Effect of government expenditure on supply of money. Does government have any hold? Ideally, yes. It must have the hold. It cannot say that let the money flow as it is. No, it's not possible. When the government departments fall short of money, the RBI gives them loan called as ways and means advances and or the overdraft loans. This is one more source of coming money into the market. Let's assume that railway department is in loss. I wish it will always be in profit. But if for consistently for 5 years, that railway department is in loss, what to do? They need cash to make the payment of their salaries. They take the loan from government or overdraft. Also, money flow comes in, it is given to public. Again, money is available in the market. The RBI reserves comes to public in the form of salary from government departments, as we have discussed. So that is called as the loan given by government to government departments. Now coming to the concept credit multiplier. What is this credit multiplier? It is the process by which banking system uses the same amount with multiple effects. I think we must have seen the movie Jai Ho of Salman Khan. In that movie what he says, don't say thanks, better do something good for 3 other person and tell them that don't say thanks, do it for other 3. So it will be a multiplier effect. एक आदमी ने 3 लोगों का help किया, these 3 will help 3 into 3, that is 9, multiplied by 327, and like this. So that is credit multiplier effect. What is that? When a person invests the amount into the bank, that amount is available as a loan for the other person. When bank A gives that loan to the other person, he will invest it in his bank, that is deposit it in his bank. Again that bank will give the same amount as a loan to the other person. Then there will be no limit for the amount. Sir, तो 1000 रुपए किसी ने रख दिया तो 1000 रुपए तो हर किसी को लोन मिलता रहेगा? No. There is a restriction of CRR and SLR. Let's see. This process basically is called as credit multiplier, money creation by bank. But there is a restriction of CRR and SLR. Let's see how. It is the process by which the banking system uses the same amount with multiplier effect, thus also called as money creation process of the bank. Here the amount deposited by one person is available as a loan for the other person after deduction of reserves, that is CRR and SLR. For example, if the amount deposited by Mr. A is rupees 2000, let's assume he is NRI, came back to India, converted his forex into rupees, and 2000 rupees he invested into the bank, the new fresh account holder. And reserves are 10%. Now what bank will do is, bank will reduce 200 from it, 1800 is given to the next person as a loan. Then Mr. B will get 1800 as a loan from that bank. Further, if Mr. B deposited that 1800, I got a check of loan, so I deposited that check into my bank. So deposited 1800 into the bank, bank will again lend 1620 to Mr. C as a loan, because again there will be 180 rupees as reserves. Further, Mr. C will deposit into his bank and the bank shall lend it to Mr. D 1458 only. Why 1458? 1620, as we have seen, 10% is CRR. So 162 amount will be kept as reserve, further amount is given to the next person. The same amount, 2000 amount, is made available to the next person. In this way, the same amount is available to multiple applicants. Lower are the reserves, more will be the credit creation. Of course, let's assume reserve is 0. So same 2000 will be available to the next person as a loan. Of course, that is not technically possible. But lower is the CRR and SLR, more will be the amount. Number of times credit creation will happen. Sir, कितने लोगों तक ये पैसा जाएगा? Because as we can see, just like WDV method of depreciation, amount is coming down. So how many times it is possible? Simple formula. Initial amount divided by percentage of reserves. So if the reserve is 10%, then 10 times amount shall be created, that is 1 divided by 0.10. So 2000 रुपए अगर आप रख रहे हो divided by 0.10, so 20,000 का money creation हो सकता है. So that was the money creation process by bank, that is called as credit multiplier. To conclude, coming to the end of this chapter, money supply. The supply of money not only depends on demand for money, but also so many other related factors like the policy of central government, central bank, then behavior of public, what are the reserve ratios, and number of factors are there. So to conclude on this note, the supply of money is just not depending on demand, it depends on so many other factors. That is what you have to understand in detail. Maybe in future you will be a finance minister and will take the control of all this. I wish you will do this in a short period, but before that we have concluded with this chapter, revise it properly, and in the next unit we shall actually understand how control is kept by government. What are the tools available in the hands of government and central bank to control the money supply. So this was chapter 3, unit 2, money supply. Thank you.